Yeah.
Okay.
So, dear traders, good evening. How are you all? It's a hope that you're doing great. This beginning of the year 2023. Today we want to look at a strategy that someone can use during times of news. And the strategy that we want to use, what I want to look at today is a straddle strategy.
Yeah.
So Sam, you can take us through.
Yeah. Good evening, guys. I hope everyone is doing okay today. Mathew, I hope you're good in Nakuru.
Yeah, great. All
Yeah.
is well.
Yeah, that's nice. So yeah, so we have a very eventful week this week, from various central bank governors speaking to key economic releases. So we thought maybe, because this is a question that some of the traders have been asking, we cover the straddle strategy today, and that's what we're going to discuss. So it's a very interesting concept, because some traders can really vouch for it. Some traders are not really up for it. So it's up to you to gauge and decide, is it something that you're going to use? Although we will cover it so that you know what it is, or when you hear it somewhere, you know what exactly someone is talking about. So that's the straddle strategy. It's basically trying to take advantage of the market despite the direction it moves. Usually it happens before a large volatility event. So sometimes you find that the market is quiet and all of a sudden there's this spike in either direction. And traders often attempt to take advantage of that by entering into a straddle. I believe, Mathew, you've tried this before. Maybe you can explain also. What are your thoughts?
Well, just like you say, there are traders who will really dispute the success of this. But you see, just like you've explained, the straddle strategy is where you're positioned to make a profit based on where the market goes or where the price goes, whether it pushes to the upside, whether it pumps the upside, or whether it falls. So if it's applied properly, then I think it can give some good profits. Although there are the characteristics of or the behavior of the price at that time sometimes make it challenging, but it's a strategy which works.
Yeah, and the concept is borrowed from options.
The concept is borrowed from options. Yeah, you see, with borrowed options, where you have the call and the put.
And the
So
put, yeah.
where you have someone putting a call, okay, you enter a call and a put, right? So that's an option, so that whichever direction the price goes, then the trader is positioned to make a profit. So that one also in trading is where when the markets are really volatile and the price moves quite fast, within a very short time, you can have the price shooting or maybe moving up to 100 pips, sometimes even 200, but mostly it happens around the news when you have releases. The impact of the event is very influential on this one, determines how much the price moves. So as we're moving along, we will discuss the targets that one can have, right? And the precautions to take when using this strategy.
Exactly.
Yep.
Yeah, so there are a few steps. I think one thing is we've mentioned volatility a lot, and that's basically one of the things you need to know. You need to be anticipating a high volatility event even before you consider getting into a straddle. So a high impact event can be because of a number of reasons. It can be a market open session. Maybe there was news over the weekend, and then there's market open. It can be news that is coming in just then, or at maybe high impact news. So it can be a number of things that you need to be able to predict with certainty that this is indeed going to be a high impact event, or it's going to cause the market to move drastically in one direction or the other. Because at the end of the day, you're not really trying to have a directional bias. What you're trying to do is predict volatility and try and take advantage of that sharp movement in either direction. That's the first thing, which is look for high impact event or anticipate when there's going to be high volatility in the market. And then also select a lower trading time frame, because a lot of the times volatility is very common in low time frames than it is in larger time frames. Generally, you'd have the market already moving in a number of hundreds of, probably hundreds or tens of pips. But on lower time frames, we usually have the impact of burst in volatility being felt more. So, and then again, volatility doesn't really last for a prolonged period. So using a larger time frame doesn't really give you accurate entries as you will get in lower time frames. So if you're using maybe a 15-minute, 5-minute, 3-minute, 2-minute, 1-minute time frame, those are good enough. When you start going higher, then the impact of sudden changes in volatility becomes less. So that's the other important thing. And then try and determine what range you're in. I think this will become clearer when you're attempting to look at examples. So try and determine your targets. This is where you intend to enter, because most of the times you're going to be using pending orders. So where you intend to enter, where you intend to exit, and where you intend to exit in profit, and where you intend to exit in the event of a loss. Because remember, you can still make a loss when you're doing a straddle. So you need to have all those areas mitigated. So once you've determined your range, if you're intending to get into a straddle with pending orders, then you'd set a buy stop above the range and a sell stop below the range. So you've bracketed your setup so that if there's volatility, then it can move in either direction. Your order gets filled. So at this point, you'll probably need to have a good broker that can process your orders, that is automatically connected to the market, so that you don't have a slippage or delay in getting your order filled, because sometimes prices can move drastically and then you find that your order gets filled quite late in the market. So you need to know how to, you need to have to know your brokers. In short, you need to know, like for example, for FX Pesa, we probably have one of the best, if not the best, execution speeds, and that's something that you need to be looking for when you are attempting to do such a strategy. Is the broker you're using an ECN and things like that? And then set trailing stops and pending. Actually, this is supposed to be set trailing stops and stop losses. So sometimes you can get into a trade and the trailing stop doesn't get triggered. So you still need to be able to set, number one, your stop loss, and then monitor it. Because if the trailing stop is not triggered, then sometimes the volatility event can be so drastic that we have a very big price change in such a short time. So you need to set a trailing stop, and number two, monitor how the trade is going when you're on the screen. And then finally, once one pending order has been triggered, you'd probably want to close the other order, because you wouldn't want a scenario where the market has gone in one direction and then it's come back. Most of the times, if the market whipsaws, you'd want to be out of both trades, because you don't really know the directional bias, or there's never really a directional bias after the news. So you probably want to manage your orders accordingly, depending on which one has been triggered and which one has not. But this will become clearer once we use an example. Matthew, anything to add on top?
Everything is this is very simple. Maybe to stress on the fact that traders need to understand appending orders. Yeah, if you're placing a pending order, how do you do it? Because you just be putting stop orders. Yeah, so buy stop or sell stop. That's what you need to set, and just need to be careful on the volatility as at that time before the news. It has to be a little bit far from the current price, not too far, a little bit far, and also want to make sure that the trade is not executed before the news come up, because it might end up unsuccessfully. It might end up taking up the trade, but then moves in the opposite direction, or gets momentum on the opposite direction after taking the trade. So whether one uses the trailing stop, again, it depends. It's always better, but you see, with the trailing stop, again, the choices that you make with the trailing stop or not putting the trailing stop affects the trade. You must accept them, because sometimes you might have a very big pullback or a very fast pullback, takes out the trailing stop, and then the price proceeds. So it's a matter of choices. But for me, do I support use of trailing stop? I mean, the automatic trailing stop, not much. I think I would consider, if someone is there and just move the
to be on the
stop loss, you just move the stop loss to the break even, right? And if the price moves strongly in one direction, then you can just have it hit the take profit, or just move the trailing stop to sell.
Yeah, that's true. That's true.
Yeah.
Probably, I think for trailing stop, it's if you're not that alert and you're attempting to trade, then probably you'd want, as a last resort, the trailing stop to track the current price.
Yeah.
Maybe,
so someone is asking what's a trailing stop. Peter Simiran is asking what's a trailing stop. Maybe you can mention something about it.
So so a trailing stop basically it's a type of order that you send to the broker that exits your position. First off, a stop what is it called? A stop loss order is an order that you send or you add on the system, so that when price hits a specific level, you're exited from that trade. So if you're in a buy and it starts going, when you're in a buy, obviously you're expecting the price to increase, but if it starts going lower, then you can set an automatic order to be exited if a certain price level is reached. So a trailing stop is just a more advanced stop loss order, where that point is, instead of a fixed number, it's a fixed distance from the current price. So that if, say, for example, price is 10 shillings and it goes to, and you said that your stop loss should be 5 shillings away. See, if the price increases to 15 shillings, then now your stop loss is at 10 shillings. If the price increases to 20 shillings, your stop loss is at 15 shillings. So basically, that's a stop loss. It's an automated way to track your momentum without necessarily reducing your risk allowance or increasing your risk allowance.
Sure.
Yeah. So Mathew, maybe do you have any examples on your end?
Yeah, I have a couple of them we can look at. So I will have to share the screen.
I'm just curious though, if we had what are some of the news events that can be considered as high volatility or high impact events that can affect the market that traders need to watch out for?
I mean, you're looking at events, the specific events like inflation, data on inflation, yeah, retail sales mostly, and also the statements that are made by governors of the central banks, various central banks. Then when we talk about inflation, of course, we're talking about on the side of the producers, or the manufacturers and also on the side of the consumers. Those are the some of the key events. You can also look at GDP, that's the gross domestic production, right? Mostly, if traders want to understand what those events are, you can look at the economic calendar and go filter out so it can have very high impact events. Look at the high impact events and then look at it. For example, we can review January. Let me share my screen. So we review January and see see what we are talking about. Just a little bit. So I'm sharing an economic calendar. So just the common ones that you find out in there. Here is Forex Factory. So in this economic calendar, you see when you go to the filter button on the top right, you can filter out the impact, the expected impact buttons here. Of course, you remove the low impact, the no impact, and also remove the medium. So you want to have the high impact events, because for this strategy, you're trading the events that are likely to cause a spike in the market. And mostly that is going to be the high impact events, which are in red. So if you apply that filter, then you can see the high impact events. And mostly if you try to read through, you see it's CPI, for example. At the top, you have Bank of England, Governor Bailey speaking. We have CPI, monetary policy, that's about interest rates, retail sales, CPI just repeating itself, core PCE, and you can check these events. So there's no reason of even cramming these events. If you just go to economic calendar, filter out, and see the high impact events. So what we will do, I want us to go to, let's look at January, look at a specific event. Like for example, let's go for June 17th, where we had Canadian dollar. We had a lot of events for Canadian dollar. We had CPI, we had CPI. So that is about inflation. Now let's check what happened at 4:30 of January 17th on Canadian dollar on our chart, which I'll be sharing here. Share our MT5. That's supposed to be Tuesday, the 17th of January. So I'll just take one pair which has got a Canadian dollar. I'll go for pound card. 17th. Where is it? Sorry. Did I see whether there was a spike in the prices? So 17th. We want to see what actually happened, whether we had a spike. The news was released. The release was around 4:30. So let's see what happened on 4:30 on pound card. You can choose any instrument so long as it has that currency as a pair. Around 4:30, 3, 4. So
this was 4:30 a.m.
was this 4:30? Let me check again. It's supposed to be 4:30 in the evening. But this one is not as clear. We can go and look at another event. That one is not clear, so will not help us much. And we are looking for a very clear example to offer here.
So the type of events, mainly inflation, interest rate decisions.
Yeah, sure.
And,
looking
and,
at these high impact events. These
so
high
this is on
impact events.
25th of, yeah.
Yeah, these high impact events. So you can go 25th. 25th is quite clear. And you can see for 25th, we had the Bank of Canada monetary policy report. This is about interest rates. And at this point, you see they raised the rates by 0.25, just 25 basis points. And this raised the strength of the Canadian dollar. And let's see what happened on the chart.
This is pound Canadian, yeah?
Yeah, pound card. Actually, it's like it weakened the Canadian dollar. It's weakened the Canadian dollar because it came as expected, right? So not surprising, right?
Yeah.
So how could someone have traded this one? One of the conditions that one of the steps. So number one is just check when the event's coming up, and you need to be positioned. You need to be on the charts early enough. Let's say 20 minutes before, to set up your positions or to just analyze. So what you're going to do is if it's a Canadian dollar which has got that, the event is coming up for Canadian dollar, then you can choose any instrument, right? But mostly the one that you expect is going to be volatile. So in this case, here we have pound card. So what you do is you study the movement which is there. Do you have a consolidation? Because if there is a consolidation, for instance, here where the price is not moving beyond this level, so once that high impact event comes up, then there's a likelihood from that point the price will either spike to the upside, just like it happened here, or spike to the downside. So in this case, it just went up. So you're on a lower time frame, 5 minutes. The reason why on a very low time frame is because that's where you see, that's where you actually zooming out, so you can focus on the big movement which happened. So in this case, the movement which came up was around how many pips? Went all the way to 100 pips. Okay. So usually what someone would do is identify the range, then a few pips away can be 10, depending with how the price is obeying that range, 10 pips, or let's say 10 pips away, you place your pending order. So in this case, the pending order could have been at this, from this level, let's say 10 pips away, maybe around there. Have your pending order, a buy stop at that zone, right?
Yeah, so I think usually after you've identified the time the news is coming out, the next thing is you're attempting to measure the volatility in general. So on average, the last 10, 20 candles, what has been the rough estimate in terms of pips or points that the market has been moving? Once you've established that, then now it becomes easier to know how far your pending order should be from where the range starts. Because at the same time, you're also trying to avoid being whipsawed from the market, right, Mathew?
Yeah. So for me, I think by looking at the range, can easily help the trader see the volatility. On average, how far is the price moving before you have that strong upward or downward push of the price or spike? Yeah. So you have the buy stop at around that. Let me put a different color code. So buy stop at this part here, for instance, and then the sell stop on the lower side. So once this is triggered, then of course you can get the other order out, and then you see how the move was. Mostly have a target, because there are some times when the price spikes up and then goes back again, like was the case when we had CPI with with gold.
That's true.
Yeah.
Someone is I'm getting a question from a comment rather.
Yeah, someone is disputing
about slippage. Yeah, that's true. When you have when you're attempting to trade the news, especially CPI or interest rates, you tend to get a lot of slippage in the first minute, the first 3-5 minutes. because number one, you have a lot of repositioning in orders. So you have some traders exiting their position, maybe because the news has come a different way. Some traders will be adding on to positions, and you also have a lot of traders who have pending orders during that time. Also, liquidity tends to be very thin in one direction. That means if, for example, the news has come out and it's a buy, then you find that there are very few sellers within those prices, and that creates a lot of slippage. So the best thing to do is to not go to a very low time frame, like extremely low, like the fast, the minute time frame for your analysis. You'd want to be maybe a 5-minute time frame. At least the first few minutes slippage is very, very high because we have a lot of that, the repositioning of trades. Once that is cleared, if it's high impact news, then it tends to trend in one direction for a really long time. The second thing you can do to avoid for example, slippage or being whipsawed is you need to do a back test. So Matthew, you've shown us the economic calendar. Can we have a look at that? Good.
Yeah, we have the economic calendar here. Let me just put it up again. Yeah, we have it.
So the economic calendar, once you click on one, for example, let's click on
which one do you want us to look at?
US CPI or whichever. For example, non-farm, the one that's currently then ADP non-farm.
We can look at CPI that came up on 12th.
Okay, let's look at that one.
Yeah, so if we can speak something also about the USD.
A good first step for a trader will be to back test, and that's one of the disadvantages we've mentioned in the charts. So a good first step is to back. And what do I mean by back testing? You can expound on one of these news items. For example, the CPI. Just click on details.
I mean, go to the
details for that.
To the core.
Yeah, let's try that one.
Core CPI. And here
exactly. So now it gives you a history of previous announcements from the charts. For example, December 13th, we had another announcement and so on and so forth. Now it's up to the trader for each news item to understand, based on the actual and the forecast, how does the market typically react? For example, if the news comes in and it's equal to what was forecasted, on average, what reaction does the market give? If the news comes in, if the actual comes in higher, what reaction do you expect to see from the market? If you have 2 or 3 samples, you begin to get an idea on the 5 minutes or the 15 minutes of what to expect. And one interesting thing, Matthew, you'll find out is that not all these items in red actually give you high impact price movement on the charts. So the first step, if you are preparing, probably will take more time than to actually trade it preparing. You'd need to back test and have a comprehensive understanding of how the market tends to react to certain types of news. Because, for example, NFP will have a different reaction from ADP payrolls and things like that.
Yeah, just to add on what you're saying. I mean, when the news comes up as expected, the situation might be that it's already been priced in. So you might not have a very big move. If the news comes up as a big surprise or way much worse than expected or way much better than expected, that's one then causes a big shake in the market. So it depends with how the news comes up. So it's not automatic that you're going to have a very big move and with a clear upward direction or clear downward direction. Yeah, so still it depends. Like in this case here, I had the CPI. You see, and I was actually watching this particular event. Yeah, the story of slippage, that's for sure. But on being stopped out, there are several factors a trader needs to observe when you're trading during these high volatility events. Don't trade on these high volatility events if you know that your capital is not quite good enough. And even if you have your capital quite good enough, then have a low lot size. Remember, one rule of risk management is if you are trading in a very highly volatile events, have a small lot size, because of course, it's going to make a very big move. If normally you would target like, let's say a movement like this, a small movement to give you 30 pips, and it takes like how many candlesticks? Several candlesticks, like 5, 6 candlesticks or 10 candlesticks to give you 10, 30, let's say 30, 25, 30 pips. But then you see in just a single candlestick, this thing is just going for like, how many pips are these? 140. So when the markets are calm, when the markets are not volatile, usually you can take a trade even with a bigger lot size, and you don't actually suffer. You're not exposed to that very high risk. But now, if you trade this news with the mentality of killing the market or making it all of a sudden and tripling the account, that's when the account blows, right? And considering the fact that even with those straddle orders that you're putting there, you even have a stop loss as well, right? So yeah, it can mess up, but please try to observe those few tips that I've thrown in. That's for sure. If you're not very careful and if you put very big lot size in the account, it can just wipe out. So again, this is not a strategy for everyone. If you're risk averse and you're not a fan of fast moving markets, then when the news are coming up, play the safe rule, stay away. But if you're in to ride that risk, you can use the straddle approach. Yeah.
I think that sums it up.
Yeah.
You wouldn't want to straddle every news item that comes out. But of course, if you backtest, then you'll know what to look at and what not to look at. When it comes to. And then the other thing is, make sure to understand the concept of margin and how much margin you have in your account, so that you know what it is you want to risk. And lastly, having your stops, because you never know. It's usually high impact, so you never know if it's going to whipsaw back and all that. And just being there in the market, if that's possible when you're trading.
Yeah, for me, I think when you're trading this straddle strategy, and even with the news, I mean, that's not the time to have like a very crazy target, because this is where the market can pull back and reverse very fast. This is where someone needs to be very discreet on whether you're targeting like 30 pips, 50 pips. But again, it depends with the events. There are events where you can have bigger targets with this news, and there are some that you need to be very careful. So just to make sure that your targets can be achieved within a short time, and you're out of the markets, you collect your profits and you leave the rest. Just have a modest target. Just because there are news, not the time to be greedy, not the time to now think of tripling the account. That's my approach. That's how I view it. For example, if someone was targeting $50 with this gold move, I mean, it came up down here, though this one was very fast. It shot down very fast and then went up again. But someone was looking for like 50 pips. This thing went for around 140. So 50 pips, and within a second or 2-3 seconds, that's in, and then you're out. Because actually this movement, the price whipsawed here. It went all the way down, shot up again, pulled back again, right? So.
And I can see you made a series of successful trades in it from the arrows on the trade history.
Oh yeah. Oh, you can even see the trade history.
Yeah.
But that one was after. Yeah, that one was a different approach, because I didn't trade the straddle. So what I did here, I took trades after the news happened, after all this downward move and upward move. Then I waited for the price up, pulled back a little bit. This candlestick, this bearish candlestick didn't take it further. This confirmation candlestick which came up here, You can see I took some quite clean. How many pips? 60 pips. Imagine 55 pips. After that, the price pulled back again.
Yeah.
And
And it's like you
down
timed it again.
here again, took some other 50 pips. I mean that's 100 pips into trades.
Yeah.
And I didn't trade at the exact time when the news were happening. I waited a few candlesticks later just to look at the price action. So if someone doesn't want to trade when that volatility is hitting up at the middle of the news release, give it some time, observe the candlesticks, enter your trades, and just get satisfied and get out.
Yeah, which is an interesting point you've brought up. You can generally there are 3 ways to trade the news. You can either place a trade before the news, during the news, or after the news. So trading during the news is, for example, using a straddle because you're trying to take advantage of volatility. Trading before the news is you're attempting to predict what the news is going to be. This happens a lot in macro environments where people have analysts and all that, and you can predict and say maybe inflation is going to increase. And so you place a trade based on that. And then there is trading after, which you're now trying to find the same setup you usually use, but in a high volatility environment to sort of get more pips.
Yeah, sure. So for my end, that's what I have about this strategy, the straddle strategy. Remember, you as a trader, you don't have a single strategy. You need to know different ways of approaching the market depending on the situations. Yeah, low volatility situations, when the markets are trending, when the markets are ranging, when the news are coming up. You see, so it's always good you have different approaches so that you can take advantage and you can be consistent irrespective of the times, the trading, the times, the environment in the financial markets. So for the ones who are interested to trade with the news, practice straddle. Practice, of course, this week, just like we mentioned from the beginning, we have quite a lot of events lined up. A lot of events lined up.
If you're practicing, maybe you can use a demo account first, see how it
Yeah.
goes.
Yeah.
Test out if there is slippage. Is there slippage in demo accounts, Mathew? I don't think.
Yeah, you find slippage on that. Also find slippage as well, I think.
Yeah, because it's supposed to mimic the real life. Yeah, so test out all that so that at least you're more the only drawback is you get like 1 or 2 very high impact events per currency per month.
Yeah.
So
this week is going to be crazy, by the way. There's a lot of events coming up. Look at the US dollar. All these are opportunities for us to test that strategy. Look at pound. It's like we have a series of monetary policy statements and interest rate releases. So that then seems that we've presented this strategy at the right time when traders have got time to test and the situation's favor.
Yeah, because you're always testing at the end of the day. Testing, finding out new ways, what people are doing, and I think it's a continuous learning environment.
Sure. So I think we can call it a session at that point.
I guess, unless there are more questions.
I don't see much questions.
So this week we have when exactly do we have maybe you can because you're already on Forex Factory, maybe you can show us what dates certain events or specific events are.
Oh yeah, I can mention that one. Like tomorrow 31st, we've got consumer confidence for the US, GDP for Canada coming up at 4:30. Yeah. On February 1st, we have quite several. We have got USD, ISM, and the statement Fed's funds rate. Yeah. The exception now at 0.25 raise. Yeah. Then we have on Thursday, England as well, or Britain. Bank of England will be releasing their their bank rates. Okay. And these
And then
official bank rate votes,
we also
euro
have for the
as
euro.
well. So this and we have non-farm employment change coming up as well. Non-farm payrolls this Friday. I mean, this week is
It's packed because that's
it's packed.
volatility back to back.
It's a beautiful week when it comes to trading fundamentals. Yeah.
Yeah.
All right then.
And then,
So unless you have something to add, Sam, we can call it a session.
yeah, I think we can call it a session. We've covered the straddle because of the requests, and a lot of people wanted to know what it is and
How to trade the news, yeah. How to trade
exactly.
during
So
the news and all that. You can use Straddle if you
that's
want
just
to.
one of the options. Yeah, exactly. So
Yeah.
that's just one of the options that
Yeah.
you can go and try out and see if it works.
All right. Okay, then thank you so much. Have a great evening, everyone, and see you in our physical classes for the ones who will be able to attend.